All right, here we go with some Chapter 9 sample example problems. We are working with receivables. This first problem has us working with notes receivable. Galen accepts from a customer, Picard, a $6,200 for month 12% note. That note is dated May 31st in settlement of Picard's overdue account. Essentially what's happening here is Picard owes Galen money. There is a receivable on Galen's general ledger from Picard. It's overdue. Picard reached out to Galen and said, hey, I can't pay you what I owe you yet, but I will give you this note in exchange. So Galen's willing to accept that note because Galen's eventually going to be paid the $6,200. They're also going to get interest at a rate of 12% for those 4 months. So the first question, what is the maturity date of the note? If the note is dated May 31st and it's a 4-month note, it means that note will mature the end of September because essentially it will be all of June, July, August, and September, and then it will mature. So September 30th would be the maturity date. The entry that will be made by Galen at the maturity date will involve the payment of the interest on the date of maturity along with payment of the note. So let's calculate the interest that Picard will have to pay when they pay off the note. Interest is calculated by taking the face amount of the note, multiplying it times its stated interest rate times the period of time that the interest is accruing. The face amount of this note is $6,200. The stated interest rate is 12%. If we were to just take $6,200 and multiply it by 12%, that would give us an annual amount of interest. However, Galen has only earned 4 months worth of interest because this note was in existence for only 4 months. So we need to multiply this annual interest by the fraction of the year, 4 out of 12 months, or 4/12 of the year. So if we multiply 6,200 times 12% times 4 divided by 12, we come up with interest of $248. When Galen receives payment from Picard on the 30th of September, they will receive $6,200 for the note plus $248 in interest. They will receive total cash of $6,448. That cash being received is paying off the note receivable, so we need to decrease notes receivable with a credit, and we record the $248 as interest revenue for Galen. Now let's take a look at a note that is issued in one accounting period, but it will not be paid off until the next accounting period. So Galen is accepting another note from Picard. It's the same amount of the note. However, this is a 9-month note instead of a 4-month. Still 12% interest. It's dated May 31st. Remember that we have to make sure that revenues that are earned within an accounting period are recorded and reported in that accounting period. This note is spanning 2 accounting periods. It's a 9-month note, which means if it is issued May 31st, it will not mature until sometime next year. Okay, 7 months of that note, all of June, July, August, September, October, November, and December. 7 of the months of that note, 7 months worth of interest are earned during that year that the note is issued. The other 2 months of that interest will be earned the following year. So at the end of the current year, nothing has been paid by Picard on that note. However, Galen has earned revenue for those 7 months, interest revenue. They need to record an adjusting entry on December 31st that reflects the revenue that was earned that will not be paid until the note is paid off 2 months later in the next accounting period. So the adjusting entry will be to record revenue earned that will be paid at a later time. The amount of interest that was earned for that 7 months is the face amount of the note times the stated interest rate times the fraction of the year, 7/12. So 6,200 times the 12% interest rate times 7 divided by 12. interest of $434 is earned during the current year. We will record $434 of interest revenue on December 31st. We will also record an increase to a receivable for the revenue that will be paid 2 months later in the next accounting period. So record a receivable and a revenue at the end of the year. The entry that will be made by Galen when this note matures, assuming that Picard pays the note and interest in full at that time. The total amount of interest Picard will have to pay Galen is for a full 9 months, $6,200 times the stated interest rate of 12% for 9 months, because this is a 9-month note. Total interest that will be paid is $558. That means that the total cash being received by Galen will be $6,200 plus the 9 months worth of interest. We will debit cash for $6,758. That cash will be received because Picard is paying off their notes receivable. So we will credit notes receivable for $6,200. That cash is also paying off last year's interest receivable. So we will decrease the interest receivable that's in the general ledger from last year. And we will record another $124 worth of interest that was earned this year. Okay. The total interest earned was $558. Of that, $434 was earned last year, so the other $124 of interest revenue is earned this year. In this problem, still working with notes receivable, we're going to work with a situation where a note is dishonored. In other words, the note is not paid when it becomes due. On May 2nd, Klein's Org Company lends $7,600 to Everhart. Klein's Org, is receiving a 6-month 9% note. The note will mature on November 2nd. When it matures, Everhart indicates that it cannot pay the amount. So let's first prepare the entry to record the issuance of the note. If Klein's Org is loaning money to Everhart, they will, on May 2nd, decrease their cash because they're giving cash to Everhart. And they will increase notes receivable because they now have a new note receivable from Everhart. Decreasing cash with a credit, increasing notes receivable with a debit. Now, let's prepare the entry when the note matures on November 2nd. When that note matures, we cannot, and the holder of the note doesn't pay it off. We cannot leave the note as a notes receivable in the general ledger because technically we don't have a valid note receivable anymore. We still have a receivable. The customer or the Everhart still owes that amount, but technically it's not a note receivable. It has now become an account receivable. That means we have to decrease the notes receivable because it no longer exists. So to decrease the notes receivable, we will credit it $7,600. We are going to put that back as an account receivable. However, Everhart doesn't just owe $7,600. Everhart owes the amount that they borrowed plus interest. The total interest that they owe is the face amount of the note times the stated interest rate, and it was a 6-month note, so half of a year. You could do the same fraction by doing 6/12 because we've been looking at it as the fraction of the year, but that's the same as 1/2, okay? Because it was issued on May 2nd and it matures November 2nd. That's 6 months. So the total interest that Everhart now owes is $342. That's the amount of interest that Klein's Org has earned. So they are going to record it as interest revenue, and the total receivable is now $79.42. So finally, the last scenario, we are going to prepare the entry to record the dishonor of the note, assuming that Klein's Org Company does not expect collection in the future. So essentially, the customer or the Everhart cannot pay, and Klein's org is fully aware that they will never be able to collect it. So instead of trying to put it back into accounts receivable, like they did here in scenario B, they just said, you know what, we're not going to collect, let's just write it off. So to write off a note, it would be the same way if we were writing off an account receivable too. If we're writing off a receivable, we are going to decrease the receivable with a credit, and we will debit the allowance for doubtful accounts. We do not record the expense for bad debt here because we've already recorded that in our month-end adjusting entries. When we write off a receivable, we just decrease the receivable and decrease the allowance account. Let's look at a write-off of an account receivable, and you'll see it'll be handled pretty close to the same. On December 31st, Jarnigan estimates that 2% of its net sales of $400,000 will become uncollectible. The company recorded this amount as an addition to the allowance for doubtful accounts. The next year, on May 11th, Jarnigan Company determined that Terry Fry's account was uncollectible and wrote off $1,100. On June 12th, Fry paid the amount previously written off. We are going to prepare these 3 journal entries, starting with the December 31st journal entry. This is the adjusting entry that companies make at the end of every accounting period to record their bad debt. They are recording an estimate of how much of their sales during the year that were credit sales will be uncollectible. They are using the percentage of sales method. That method is a one-step calculation to calculate the bad debt expense. The percentage management estimates to be uncollectible, which is 2%, times the net sales of $400,000. 2% times $400,000, we are going to record bad debt expense of $8,000. We debit bad debt expense, and we credit the allowance for doubtful accounts. Now on May 11th, Jarnigan determined that Terry Fry's account was uncollectible and wrote off $1,100. When we determine that a particular customer's account is written off, we don't need to record any bad debt expense. The bad debt expense is recorded in the adjusting entry at the end of the year. When we write off an account, just like we did in the previous problem with the notes receivable, we just decrease the account receivable. We will decrease accounts receivable for the $1,100 for that customer's account, decreasing it, and we decrease the allowance for doubtful accounts. Okay. Essentially what's happening here is when we recorded the allowance for doubtful accounts adjusting entry, we make the assumption that this is one of the bad debts that we had prepared that entry and recorded the expense for. So if we are now writing it off, we no longer need $1,100 in the allowance account because the account is now written off. On June 12th, out of the blue, the customer came back and paid off what they had previously not paid and that the company had previously written off. We want to collect that money. We're not just going to tell the customer, hey, don't worry about it, we wrote off your account. The company wants the cash. So on June 12th, before they can record the collection on the accounts receivable, they need to have an account receivable in the general ledger. So essentially what happens is the journal entry that was completed to write off the account, we are going to reverse that journal entry. Essentially, we shouldn't have written it off because it wasn't the uncollectible account we thought it was. So we are just reversing it. We are putting it back into accounts receivable and increasing the allowance for doubtful accounts. Once we have the receivable back in the general ledger, then we can record the cash collection on the receivable by debiting cash, crediting the accounts receivable. All right, let's continue working with some problems related to the accounts receivable. We are working with the ledger of Hickson Company at the end of the current year. Their accounts receivable shows a balance of $120,000. Their sales revenue account has a balance of $840,000, and their sales returns and allowances has a balance of $30,000. Hickson, assuming Hickson uses the direct write-off method to account for uncollectible accounts, we're going to journalize the adjusting entry at December 31st, assuming that Hickson determines that Fell's 1,400 balance is uncollectible. Now, this direct write-off method is one way to do it. However, generally accepted accounting principles don't allow this method. The generally accepted accounting principles require companies to report using the allowance method. However, some small companies do use the write-off method, and they do it this way. The write-off method simply says we record the bad debt expense at the time that the account is written off. So we would debit bad debt expense, and we would credit the accounts receivable to decrease it. Okay. I want to focus on the allowance method. If the allowance for doubtful accounts has a credit balance of $2,100 in the trial balance, they want us to journalize the adjusting entry at December 31st, assuming first that bad debts are expected to be 1% of net sales. If we are using 1% of net sales, it means we are using the percentage of sales method. And the percentage of sales method says that we are going to take the net sales, multiply it by the percentage uncollectible. That will directly calculate bad debt expense. It's a one-step calculation using the percent of sales method. So net sales is going to be our total revenues of $840 minus the returns and allowances, $810,000 times 1%. We will debit bad debt expense for $8,100 and credit the allowance for doubtful accounts for $8,100. If we were to use the allowance for doubtful accounts and use 10% of accounts receivable as our estimate of bad debts, this is using the percentage of accounts receivable method. Under the percentage of accounts receivable method, we are going to take the balance in accounts receivable, $120,000, multiply it by the percentage uncollectible, which is 10%. That calculates for us the total amount that we need in the allowance for doubtful accounts. The allowance for doubtful accounts currently has a credit balance of $2,100. If we calculate that, let me go back up here and get the calculator up. If we calculate that we need 120,000 times 10%, well, let me try that again. 120,000, times 10%, we calculate that we need a $12,000 balance in the allowance for doubtful accounts. There is currently a $2,100 balance on the credit side of the allowance for doubtful accounts. So we need to increase the allowance account from $2,100 to $12,000. The difference between those two is $9,900. We need to debit bad debt expense for $9,900 and credit the allowance for doubtful accounts for $9,900. Notice the difference between these. Percentage of sales method is simply taking the amount of the sales times the percentage uncollectible to get the bad debt expense. However, the percentage of accounts receivable method first calculates the balance needed in the allowance account. And then the second step is to compare the needed balance in the allowance account to the current balance. This third scenario is going to change things up slightly. Instead of the allowance for doubtful accounts having a credit balance, it currently has a debit balance of $200. So journalize the adjusting entry, assuming bad debt expense are 0.75% of net sales. All right, let's do this with the percentage of net sales method. So the percentage of net sales says we take the net sales, which is gross sales minus the returns and allowances, 840,000 minus 30,000. Multiply that by 0.75%, so 0.0075. The total amount of bad debt expense we just calculated using the percent of sales method is $6,075. Our journal entry will be a debit to bad debt expense and a credit to the allowance for doubtful accounts. Now let's assume that we are using the account receivable method, the percentage of accounts receivable. Remember, the percentage of sales is a one-step calculation to calculate bad debt expense. The accounts receivable method is a two-step calculation. The first thing we're going to do is multiply the accounts receivable balance by the percentage uncollectible. Our accounts receivable balance is $120,000. So multiplying the balance times a percentage uncollectible, 6%, we calculate we need a balance of $7,200 in the allowance for doubtful accounts. That's step one. Now that we know the needed balance, we compare that to the current balance. Remember that the allowance for doubtful accounts is a contra asset account. It has a normal credit balance. Because a bunch of accounts were written off, this company's balance in their general ledger is debit. We need it to be $7,200 credit. So here, because we need to get the account to $7,200, it's going to require a credit of $7,400, because $7,400 will be enough to change that debit balance over to a credit balance of $7,200. Okay. Hopefully that's not confusing. It can be, but notice that we started with a credit balance in that example, and in this example, we started with a debit balance in the allowance for doubtful accounts. Okay, we just worked with the percentage of sales method and the percentage of accounts receivable method for calculating bad debt expense. This problem is going to have us using the percentage of aging of accounts receivable. And really, this is just a variation of the percentage of accounts receivable method. Inglace Company has total accounts receivable of $93,100. The analysis of the account shows the month of the sale, giving us the current balance. Okay, and they broke it down by when those sales occurred. They did that because it enabled us to age those accounts receivable. At March 31st, the allowance for doubtful accounts has a credit balance of $1,200 prior to any adjustment being made for bad debt expense. The company uses a percentage of receivables basis for estimating uncollectible accounts. The company's estimate of bad debts is based on this aging schedule. We are in March, and what they have estimated is accounts that are between 1 and 30 days old, only 2% of them will be uncollectible. That means all sales that occurred in March on credit are 1 to 30 days old. We expect 2% of them to be uncollectible. Sales that occurred in February by the end of March are 31 to 60 days old. Sales that occurred in credit on credit in January, receivables reflect $8,500. They are 61 to 90 days old. We expect 30% of them to be uncollectible. And sales that occurred prior to January that are still receivables are over 90 days old, and we estimate half or 50% of those will be uncollectible. By breaking out the aging, essentially what we're doing is instead of applying a percentage uncollectible to the total balance of receivables, we are applying a percent uncollectible to the aging group, or what we call an aging bucket. What that enables us to do is to better estimate our uncollectibles, because obviously the older a receivable becomes, the less likely it will be to collect. Taking those balances down here, actually let me get this all into one page so that you can see it all in one place. 60,000 times 2% means we expect 1,200 of the most current receivables to be uncollectible. 17,600 in receivables that are 31 to 60 days old, 5% are uncollectible. 61 to 90, $8,500 worth, times 30%, $2,550 expected to be uncollectible. And over 90 days old, we have $7,000 worth of receivables, 50% or half are expected to be uncollectible. Total estimate of uncollectible, the total amount we need in the allowance for doubtful accounts is $8,130. Just like we did in the percentage of accounts receivable method, we took the receivable balance, multiplied by the percentage uncollectible to calculate the needed balance. Okay, here we just did it by aging bucket instead of in total. Currently, the allowance account has a $1,200 credit balance. It needs a balance of $8,130. We need a balance of $8,130. It currently has a $1,200 balance. The amount of bad debt expense we need to record to get the allowance account up to $8,130 is $6,930. Our journal entry will be a debit to bad debt expense and a credit to the allowance for doubtful accounts. Okay. All right, last problem here, kind of bring everything together. It's the end of 2009, December 31st. Dill Imports reports the following information on its balance sheet: its current balance in receivables and its current allowance for doubtful accounts. During 2010, so after 2009, the company had the following transactions related to receivables. They want us to prepare the journal entries to record each of these 5 transactions. Assume that no cash discounts were taken on the collection of the receivables. Okay, so I split the screen here to make it a little easier to follow. Let's record the journal entry for the sales on account. When we make a sale on account, remember there's 2 journal entries. The first journal entry would be the revenues being earned, and the second entry would be the cost of the inventory sold. We're going to ignore the cost of goods sold entry, and we're only going to focus on the sale entry. So here is the entry. We're going to debit accounts receivable and credit sales to record the sales on account. Then we're going to have the total sales returns and allowances that occurred during the year. Remember, we don't directly reduce revenues when we have a return or allowance. We use our contra revenue account. So we would debit the sales returns and allowances account, and we would decrease receivables. Collections during the year 2010 on accounts receivable. When we collect on accounts receivable, we debit cash and credit accounts receivable. We wrote off some accounts receivable that were deemed uncollectible. When we write off accounts receivable, we decrease the receivable with a credit, and we decrease the allowance for doubtful accounts with a debit. Then we ended up recovering some of our bad debts that had been previously written off as uncollectible, $3,000 worth. Remember, when we collect on something previously written off, before we can record the collection, we need to reverse the write-off entry. So that's what this is doing here, is reversing this entry. When we wrote off some accounts, we are putting them back into the general ledger by debiting accounts receivable and crediting the allowance for doubtful accounts. Now that those receivables are in the general ledger again, then we can record the collection. So we will debit cash and credit accounts receivable to record the collection. All right, the next thing they want us to do is to start with the beginning balances for accounts receivable and the allowance account and post the entries to the 2 accounts using T accounts. Okay, we're only going to be working with the accounts receivable account and the allowance for doubtful accounts. We're going to ignore the other accounts in these transactions. Okay, we're just focusing on those 2. So let's go back up here. Accounts receivable started with a balance of $250,000. So let's enter that into the, I did not mean to do that. Okay, so try that again. Enter the beginning balance into accounts receivable and enter the beginning balance into the allowance for doubtful accounts. Okay, now let's post all these entries. It looks like we had a debit to accounts receivable. So here's our debit. We had a credit to accounts receivable, so we'll post that into the receivable T account. Another credit to receivable for collections. We had a debit to the allowance account for a write-off and a credit to accounts receivable for a write-off. We had a debit to the receivable for writing it back on, and we wrote it back into accounts receivable to the allowance account for $3,000 with a credit. Then we had a collection of $3,000. Okay, so what we have now done is taken the beginning balance in accounts receivable at the end of 2009 became the beginning balance for 2010 and showed what happened during the year 2010. It was increased and decreased, leaving us with an ending debit balance of $343 in accounts receivable. And our allowance account started with $15,000 at the end of 2010. It was increased and decreased to get to an ending balance of $6,000. All right, so now we've got the balances in there at the end of 2010. Now we are to prepare the journal entry to record bad debt expense for 2010, assuming that an aging of accounts receivable indicates estimated bad debts are $22,000. So they have already gone in and done step one for us. They figured out, they took the amount of the receivables in the aging, multiplied it by each aging group's uncollectible percentage, and they calculated the needed balance in the allowance account to be $22,000. So we need a balance of $22,000 in the allowance for uncollectible accounts. Currently, there is a balance of $6,000 on the credit side. To get that account from a credit balance of $6,000 to the needed credit balance of $22,000, we need to increase it $16,000. Our journal entry would be a debit to bad debt expense and a credit to the allowance for doubtful accounts. Finally, in D, prepare the journal entry to record bad debt expense, assuming that 1% of net sales are estimated to be uncollectible. All right, let's go back up here and see. Net sales, it appears, was $2.4 million minus the sales returns and allowances. So $2,400,000 minus our sales returns and allowances of $45,000. Net sales are $2,355,000. If 1% of those are estimated to be uncollectible, we are estimating bad debt expense for the year to be $23,550. The percentage of sales method is a one-step calculation. We will debit bad debt expense and credit the allowance for doubtful accounts for $23,550. All right, I hope this is all helping. Reach out with questions.